Welcome. Today, we're going to put on our detective hats. You know those financial statements that look incredibly dense and, let's be honest, a little confusing? Well, we're going to transform them into a powerful toolkit, a set of clues that can reveal the real story behind a company's health.
Okay, so let's start with the biggest trap in financial analysis. I like to call it the apples to oranges problem. You've got two companies and you just want to know which one is doing better. Seems simple enough, right? But if you just look at the raw numbers, you can get incredibly misled.
For example, let's say Company A pulls in a massive $500 million in revenue. And over here, Company B brings in just $10 million. I mean, on the surface, it's not even a contest, is it? Company A looks like the clear winner.
But wait a minute, which company is actually performing better? Is being bigger automatically better? Is Company A more efficient, more profitable, healthier? The truth is that huge revenue number tells us almost nothing about the real story.
And that really gets to the heart of the issue. Trying to compare these two companies based on raw dollar amounts is kind of like comparing the fuel efficiency of a giant cargo ship to a tiny scooter. The difference in size just completely masks what's really going on with their performance.
So, how do we fix this? How do we possibly make a fair comparison? Well, we need a tool that levels the playing field. We need a way to standardize the information so we can finally see what's what. We need what I call the great equalizer. And that equalizer is something called a common size statement. The idea here is really simple, but it is so powerful. Instead of looking at raw dollars, we express every single line item as a percentage of a common base. So for a balance sheet, the base is total assets. For an income statement, it's total sales.
Let's look at a quick case study. Prufrock Corporation. Here's our initial evidence, a piece of their balance sheet with the raw numbers for 2020 and 2021. Yeah, we can see the numbers went up, but the story behind that growth, it's still completely hidden in there.
But now, watch what happens when we convert this into a common size statement. Boom! All of a sudden, the company structure just pops right out. We can see, clear as day, that in 2021, a slightly bigger piece of the pie was made up of current assets. It's a small shift, sure, but it's an insight we just couldn't get from the raw numbers. We're not blinded by size anymore.
Okay, so standardizing helps us compare companies, but to really understand what's going on inside a company, our detective needs a few more tools. So the next layer in our toolkit is financial ratios. And you can think of these as the specific, targeted questions we ask to give a company a full financial checkup.
See, ratios aren't just random math problems. They're designed to answer really fundamental questions. Like, can the company pay its bills this month? That's liquidity. How much debt is it relying on? That's solvency. Is it getting the most bang for its buck from its assets? That's asset management. And of course, the big one, is it actually making any money? That's profitability.
Let's pull out a couple of these tools to see how they work. A real classic is the current ratio. It's super simple. It just takes all the assets a company can turn into cash within a year and divides it by all the bills it has to pay in that same year. It directly answers that question about short-term liquidity. But here's the crucial insight, the part that makes you a real detective. What makes a good ratio really depends on who you are. If you're a creditor, a high current ratio is great. It means you're definitely getting your money back. But if you're an investor, a ratio that's too high could be a red flag. It might mean the company is just sitting on a pile of cash instead of investing it to grow the business.
All right, next up, let's look at financial leverage with the debt-to-equity ratio. This one tells us how much of the company is funded by borrowing money versus how much is funded by the owners themselves. A high number here means more risk, for sure, but it could also mean higher potential returns. It's that classic trade-off between risk and reward.
So we've got all these individual clues, right? We have liquidity, leverage, profitability. But what if there was a way to connect them all? A way to see how they all work together to create that ultimate result for shareholders? Well, there is, and it's one of the most elegant tools in all of finance.
It's called the DuPont Identity. And what it does is break down return on equity, which is really the bottom line for shareholders, into its three core engines. First, you've got profit margin, which is all about operating efficiency. Then you multiply that by total asset turnover, or asset use efficiency. And finally, you multiply that by the equity multiplier, which measures financial leverage. Profitability, efficiency, and leverage, the three pillars of shareholder return.
And this is where the DuPont identity just shines. Take a look at Amazon versus Alibaba. They both achieve a very similar return on equity, but their business models are complete opposites. Amazon runs on a high-volume strategy, tiny profit margins, but they turn over their assets incredibly fast. Alibaba, it's the reverse.
really high profit margins, but a much lower asset turnover. The DuPont formula shows us two completely different roads that lead to the exact same destination. It's fascinating.
So, we've got our toolkit, common size statements, financial ratios, the DuPont identity. We're all set to analyze any company, right? Well, almost. A great detective knows the limitations of their tools. They understand that this is an art as much as it is a science.
You really have to be careful. There isn't one single magic ratio that's going to tell you the whole story. And it's incredibly tough to compare a massive conglomerate that does a million different things to a smaller, focused competitor. Plus, different accounting choices can legally make two very similar companies look totally different on paper. You see, context is everything.
This quote from the analyst Robert Higgins just sums it up perfectly. The financial statements, they provide the raw clues. But it is our job, the user's job, to make adjustments. We are the ones who have to apply our judgment to figure out what the numbers are really trying to tell us.
So in the end, these tools don't just give you the answer. What they do is give you the ability to ask much smarter questions. The numbers themselves don't lie, but the story they tell, that depends entirely on the detective who's reading them. So the final question I have for you is, with these tools now in your hands, what story will you go out and look for?